How safe is Altria's dividend? On July 30, 2019, Altria reported second quarter earnings results for fiscal 2019 for the period ending June 30, 2019. This video provides an update on the company's dividend safety using its most recent operating results. Before we begin, I invite you to subscribe to our channel and like this video, which will help more people discover Sure Dividend's investor education efforts. With that out of the way, let's dig into Altria's dividend safety. To begin, let's talk about Altria's business model. Altria is a cigarette company that sells the Marlboro brand of cigarettes in the United States, as well as a number of non-smokeable brands, including Skoal, Copenhagen, and the St. Michel brand of wine. The company also has a 35% ownership stake in e-cigarette maker Juul, a 10% ownership stake in global beer giant Anheuser Busch Inbev, and a 45% equity stake in Canadian marijuana producer Cronos Group. Altria trades on the New York Stock Exchange with a market capitalization above $89 billion. Altria is one of the world's most popular high-yield dividend growth stocks. The company's current dividend yield is currently 6.8%. Moreover, Altria is a consistent dividend grower. In fact, the company has increased its annual dividend payment for 49 consecutive years. This qualifies Altria to be a member of the Dividend Aristocrats Index, a group of exclusive dividend stocks with 25-plus years of consecutive dividend increases. Altria is 1 year away from becoming a member of the Dividend Kings Index, a group of even more exclusive stocks with 50-plus years of dividend increases. For the remainder of this video, we will discuss Altria's dividend safety from four perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, its dividend safety in the context of its current debt load. Altria's dividend safety relative to earnings. First, let's discuss Altria's dividend safety in the context of the company's current earnings. In the second quarter of fiscal 2019, Altria generated adjusted earnings per share of $1.10, which compared favorably to the $1 of adjusted earnings per share in the same period a year ago. For context, Altria currently pays a quarterly dividend of 80 cents per share, which implies a payout ratio of 73% in the most recent quarter. Looking out over a longer time horizon, the company's payout ratio is lower. Altria generated $2 of adjusted earnings per share in the first half of fiscal 2019. The company distributed $1.60 of common share dividends during the same time period for a dividend payout ratio of 80% in the first half of the fiscal year. While this payout ratio is fairly elevated, Altria's dividend appears very safe for the foreseeable future when using earnings. Altria's dividend safety relative to free cash flow. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare Altria's current dividend payment to its free cash flow. Altria generated $103 million of cash flow from operating activities in the second quarter of fiscal 2019 and spent $41 million on capital expenditures during the same time period for free cash flow of $62 million. The company distributed $1.5 billion of common share dividends during the same time period, meaning that free cash flow did not cover dividend payments. Altria had a one-time charge of $1.8 billion that consumed nearly all of cash payments from operations for the quarter. Looking out over a longer time horizon, the dividend appears much safer. Altria generated $6.9 billion of cash flow from operating activities over the past 12 months and spent $245 million on capital expenditures during the same time period for free cash flow of $6.7 billion. The company distributed $5.8 billion of common share dividends during the same time period for a free cash flow dividend payout ratio of 87%. Using free cash flow, our conclusion for Altria's dividend safety is the same as when we used earnings. The company's dividend payout ratio is elevated but currently covered by free cash flow, though we encourage investors to monitor the situation. Altria's dividend safety relative to recession performance. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze Altria's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Altria's performance during this time period is shown here. 2007 adjusted earnings per share $4.36. 2008 adjusted earnings per share $1.66. 2009 adjusted earnings per share $1.76. 2010 adjusted earnings per share $1.87. 2011 adjusted earnings per share $1.64. 2012 adjusted earnings per share $2.06. Altria completed its spin-off of Philip Morris in 2008, which accounts for the drastic reduction in adjusted earnings per share that year. The company produced a 6% increase in adjusted earnings per share from 2008 to 2009. In fact, except for a decline in 2011, Altria has seen adjusted earnings per share increase every year since 2008. More importantly, the company's earnings still covered its dividend payment, and Altria continued its multi-decade streak of dividend increases. Because of this, we have little concerns about the company's ability to pay rising dividends during future economic downturns. Altria's dividend safety relative to its current debt load. The last angle that we will use to assess Altria's current dividend safety is by looking at the company's current debt level, which is a cause of concern for many investors. More specifically, we will see how much the company's weighted average interest would have to increase before its free cash flow would no longer cover its dividend payment. At the end of second quarter of fiscal 2019, Altria had $29.2 billion of total debt outstanding. The company generated $316 million in interest expense in the most recent quarter for a weighted average interest rate of 4.3%. Normally, we include an interest rate stress test in these analyses that shows how much Altria's weighted average interest rate would need to increase before its dividend would no longer be covered by free cash flow. However, the company's free cash flow did not cover its dividend payment in the second quarter. Looking out over a longer time horizon, the dividend appears much safer. Altria generated $962 million in interest expense over the past 12 months for a weighted average interest rate of 3.3%. The following image shows how changes to Altria's weighted average interest rate would impact the company's dividend safety as measured by free cash flow. As you can see, Altria's weighted average interest rate would need to rise above the 6.3% level before its dividend would no longer be covered by free cash flow. While this is lower than what we would prefer, we have little concern about the impact of the company's debt on Altria's dividend safety moving forward. In conclusion, thank you for watching today's video, which performed a deep dive on Altria's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website, suredividend.com.